Ladies and gentlemen, good day and welcome to Yes Bank Limited Q2 FY23 earnings conference call. From the management team, we have with us Mr. Prashant Kumar, MD and CEO, Mr. Niranjan Banodkar, Chief Financial Officer, Mr. Rajan Pental, Global Head, Retail Banking, Ms. Anita Pai, Chief Operating Officer, Mr. Ravi Thota, Country Head, Large Corporates, and Mr. Akash Suri, Country Head, Stress Assets Management. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Prashant Kumar. Thank you, and over to you, sir.
Thank you for joining Yes Bank Q2 financial results call. At the outset, I would like to wish you and your families a very happy Deepavali and a prosperous new year. With me, I have the top management team of Yes Bank. I also realize that today is an earning heavy day for the banks, and in the interest of time, I will be only highlighting the key points for the quarter. As you are aware, that bank has signed an investment agreement with two marquee private equity investors, Carlyle and Advent, to invest 8,900 crores. We are awaiting regulatory approval and expect to receive the capital infusion in the Q3. The bank has chosen JC Flowers, a global distressed debt fund, to acquire an identified pool of 48,000 crores of stress asset pool at a bid of 11,183, which is 135% of the carrying value on the balance sheet. Pursuant to expected closure in Q3 this year, this is said to be the largest sale of stress asset in the domestic market. There have been multiple credit rating upgrades by CRISIL, ICRA, India Ratings and CARE. Now the bank has the highest short-term rating at A1+, and long-term rating has improved to A- with a positive outlook. Now, specifically coming to Q2 financial results, bank has reported an operating profit of 790 crores, which is 34% increase quarter-on-quarter and 17% increase in YOY basis on the back of NIM expansion of 20 basis point quarter-on-quarter and 40 basis point YOY, and improving cost to income ratio to 72.8. Our cost to assets have been stable at 2.6% in spite of inflationary pressures and higher technology spends. Bank has reported a net profit of 153 crores, which has been largely...
There is some issue with the management line. Ladies and gentlemen, thank you for your patience. We have the line for the management reconnected. Sir, you may go ahead.
Okay, sure. So I think I would just like to repeat briefly what we have spoken about the financial results. The bank has reported a operating profit of 790 crores, which is 34% increase quarter-on-quarter and 17% increase on YOY basis, on the back of NIM expansion of 20 basis point quarter-on-quarter and 40 basis point YOY, and improving cost to income ratio to 72.8. Our cost to assets have been stable at 2.6% in spite of inflationary pressures and higher technology spends. Bank has reported a net profit of 153 crores, largely impacted due to aging-related provisioning requirement during Q2. The bank's pre-provisioning operating profit to asset is on track. However, any potential delay in expected recoveries may lower the expected FY23 ROA. Advances have grown by 11% YOY, of which retail has grown by 43%, SME 19%, mid-corporate 34%, and the corporate, there has been a degrowth of 18%. The bank expects the advances growth to track deposit growth. The mix between retail SME, mid-corporate, and corporate has further improved to 54% retail and SME, 12% mid-corporate, and 34% corporate. Retail advances are seeing good traction across home loans, vehicle loans, personal loans, and the bank is also looking to strengthen its gold loan and education loan portfolios. New sanction disbursement aggregated to 24,149 crore during the quarter across the segments, and despite decline in net advances on the large corporate, our new business generation continues to be strong with corporate disbursement of more than 3,700 crores. The large repayments in the corporate segment continues in the telecom and infrastructure space with disbursement to better rated corporates. On the deposit front, our CASA ratio continues to improve with potential near-term headwinds to target of 35%. In spite of these challenges, our deposit is more than 2 lakh crores, which is 13% growth on YOY and 4% quarter on quarter. On the back of a 19% YOY growth in CASA deposit, which is also 4% growth on quarter basis. The bank's focus is on granularizing the liabilities with CASA and retail deposit. Retail term deposit now at 62%. Average daily current account balances have grown by 37% YOY, and average daily saving account balances have grown by 29.4% YOY. On the asset quality front, GNPA ratio has improved to 12.9 against 13.4 last quarter, and net NPA ratio has also improved to 3.6% against 4.2% last quarter. The slippages, which is 896 crore, continue to be lower quarter on quarter and YOY. Slippage out of the standard restructured pool, they are at 303 crores, which primarily consists of one large exposure. 60% of our standard restructured advances are out of moratorium. Reduction in overdue loans within 31 to 90 days bucket is down by 3,000 crores. Resolution momentum continues to be strong with total recoveries and upgrade of 1,586 crores. The provision coverage ratio has improved to 84%, and the provision coverage ratio of the security receipt also stands at 85%. Bank CET ratio stands at 11.7% and total capital adequacy at 17.5. The risk-weighted asset to total asset is improving and is currently at 71.2. We have also added 434 employees during the quarter. All the above points demonstrate a strong momentum in the build-up of a good quality franchise. With this, I want to thank you all once again for taking the time out for joining this call, and wish all of you and your families good health, prosperity, and happy Deepavali. We can now open the floor for your questions. Thank you.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and one to ask a question. The first question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hey, good afternoon, sir. Just a couple of questions just to clarify. what is now the timelines for the JC Flowers deal to get completed, and what else steps are there? As well for the Carlyle and Advent Capital Infusion, what more steps are needed now?
So in case of JC Flower, I think the timeline would be somewhere around the third week of November. And in case of equity raise, now the only RBI approval is awaited.
And JC Flowers, when the transfer happens of JC Flowers, where do you see after that the gross and net NPLs to come in, given the current book that you have?
Our gross NPA would be around 2%. Okay, and net NPA would be around 1%.
And there will be no provisions that was needed at the time of transfer.
Right.
Okay. If you just kind of assume that based on the current progress of where the resolutions are happening, what is your expectations of credit costs for next year?
Credit cost for the next year, you are saying?
Next year, yeah. Because there's a combination between aging-related NPLs as well as resolutions that could potentially happen of that book. Where do you see credit costs heading for next year?
So Mahesh, credit cost will be a function of also some of the recoveries that we will come through at a net level. We've had a provision, non-tax provision to assets at about 40 to 50 basis points. I think we will possibly see it remain in the 50 to 60 basis point range.
Okay. So is it fair to assume that now that you have addressed the asset quality and capital issues, now it is just a question of your ability to improve the margins? That's the only variable which is left, right?
So the ability to
improve margins. That's the only last final hurdle that is now left.
So I would not be saying a hurdle. I would be saying this is the direction in which we are moving. Okay. And after taking care of all other issues, I think we are on the right track.
Perfect. This is useful. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Mahrukh Adajania from Nuvama. Please go ahead.
Yeah, hello, sir. Congratulations. So there was some disturbance in my line. So sorry, could you share the credit cost guidance for next year or this year after the transfer? Sorry, if all things go well and as per the recoveries as per your assumptions. I missed that. That's why I'm asking again. Apologies.
No, Mahrukh, we're not giving any guidance. Because clearly there are moving parts. What we indicated is that of 40 to 50 basis points is what was the provision credit cost that we have, non-tax provisions to assets as a ratio that's prevailing right now. Our expectation is that we should broadly be in the same range, maybe 50 to 60 basis points next year. That's our expectation. But please don't take that as a guidance because that's something we will also look at the start of next financial year.
Got it. And so now some questions on operations. So you've also seen a 20 basis points QOQ margin expansion. Congratulations for that first. But how sustainable are these margins, say not only in the next half, but over the next 4 to 5 quarters? Because that immediate outlook is essential for anyone to take a bigger call on the sector. Not only on your stuff, but other sectors. So that, and in general, how do you think is the sector loan growth and your loan growth sustainable? Because it is defying global trends. So how long will we be in defiance? Is my next question.
So Maru, on the loan growth, I think what we are seeing the industry loan growth around 18%, right? And you are rightly saying like this is defying the global, the environment. And we also believe that if the financial institution started pricing the risk properly, and I think the ultimate objective also in terms of the monetary policy is also to have a control on the loan growth. I think then only the objectives would be achieved. So I think over a period of time, I think we would see this loan growth coming down. But at least as a bank, we believe that this is a time where instead of running after the top line growth, we need to optimize the balance sheet, and we see that we do the transaction at the right levels. Okay. So I think for us, loan growth has been 11%, but we are expecting that we would be in a position to be around 15% loan growth by the year end. But at the same time, there are two things. We are not going to compromise on the quality, and we would not do the transactions at a rate which does not make a commercial sense to us.
Got it, sir. Sir, in terms of your own margins, any outlook?
So currently we are at 2.6, and I think the way I have tried to articulate in terms of our strategy, I would not be seeing like margins would continue to improve 20 basis point every quarter in the current situation because of these issues in terms of rising interest rate scenario. But I think in terms of a good control on the slippage of the loans, okay, and also in terms of taking a conscious call of doing the transaction at the right pricing, we would be definitely seeing an improvement on the NIMs expansion going further, but not to that extent which we have seen in the current quarter.
Got it, sir. Sir, but just in terms of deposit competition, likely to get more aggressive in the second half, how will deposit mobilization pan out? Because already the larger banks have not yet increased rates enough. Some smaller banks have. So if larger banks start increasing rates rapidly, how does deposit competition pan out? And then that impacts everyone's growth, right?
No, I completely agree with you partially. That deposit growth is something which everybody is aspiring. But I think what we have seen that even the larger banks have increased the rates significantly. Okay. But definitely since all the banks are increasing rates and there is a tightness in the liquidity, this would continue to be a struggle. But I think what we have seen that there has been a YOY growth of 11% on the deposit side, and we have been able to reduce our cost of deposit by 10 basis points. So I think we are quite confident that with the kind of customer connect, the customer service, and the products which we offer in the market, I think we would be continue to increase our deposits with a control on the cost. But yes, this would be in a very, very challenging environment.
Okay, sir. Thank you so much.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Saurabh from JP Morgan Chase. Please go ahead.
Sir, few questions. First is, your slide 6 says it's a delay in resolution. Could you just give some color on what you're seeing? Is this around the AD account? The second is on your deposits, so we've seen a 14% quarter-on-quarter current account growth and a 2% degrowth in savings. So if you can talk about that as well. And the third question, sir, is on NIMs. So fair to say that your incremental margin, which is being generated at the bank, should be hopefully closer to the 3.2-3.5% mark versus the 2.6% that you are today. So these are 3 questions, sir. Thank you.
So I think to your first question in terms of delay in the recovery, because there is always a timing issue. Okay, some of the recoveries, if we are expecting within the current financial year, if that is spilled over to the first quarter or second quarter of next financial year, so we were talking about that kind of thing. And if those expected recoveries happen as per our estimate in the current financial year, then there is no issue, but there are always uncertainties around it. The second part...
One large account or just a few accounts? So this is only one large account?
Mainly one large account, but I think it's a moving part because there have been a number of levels at which the resolutions and the recoveries happen. And sometimes there have been delays in terms of the legal decisions, legal issues, and also in terms of actually money hitting into your balance sheet. So we were only talking about this, but if all the recoveries, expected recoveries, happens as per our expectations, then there is no issue. But definitely this is one area where you can't be 100% sure. Okay, that's why we were talking about that part. The second question in terms of the NIMs. So I think NIMs, we would continue to work in terms of expanding the NIMs, but reaching to 3.2 or 3.5 is still, I think, some time away. And in the current situation where, because of the rising interest rate scenario, I think it would be a continuous challenge, but we would be improving our NIM quarter on quarter.
No, sir, I was asking the incremental business that you're generating at the bank, what will be the incremental margin on the business that you're generating?
So Saurabh, if you look at actually our net interest margins today, and because I think this will require a little bit of a context. So there is let's say the drag that we get from the NPAs. If you actually adjust for that, so I'm just giving you a number where if you look at a yield on advances of about 8.5%. You adjust for the NPAs, the standard advances book is already operating at about 9.5%, right? So the loan spreads that we are actually running on the stock of the performing book and what we are also doing incrementally is actually quite commensurate. So we've not seen a significant differential. What we are seeing is that our drag of NPAs is coming down. In the recent times, we have also seen deposit rates also pick up a little bit in the recent times. So incrementally, I am matching let's say the loan spreads on the stock of book. Let's say the run rate for the last 9 to 12 months actually was we were expanding that, which is broadly compressed at this point in time. But our endeavor is that we will want that to continue to expand as we go along. Tiding over this, current, I would say, tight liquidity situation.
Okay. So fair to say that once the capital raise comes, so between the capital raise and then the rate you get, at least on the borrowing side, that will be the bigger driver, at least from a near term perspective.
Sorry, Saurabh, I missed the last question. You think after the capital raise?
And any, upgrade that you get on your borrowing, any reduction you get, idiosyncratic reduction you get on your borrowing cost, that will be the driver of your incremental spread.
No, so it is going to be a function of continuing to improve also the mix of your deposits. So for example, for the last, let's say, 2 quarters, we are at about 30 to 31% of CASA ratio. I think there is no magic pill here. I think it's a very execution focused work of getting the 31% improved to 40% plus, number one. And number two is that at the end of the day, how do we see the loan spreads actually expanding? As I mentioned earlier, that our loan spreads were actually expanding. It's only briefly given the way the rates have reacted immediately. We've kind of seen some amount of, I would say, slight contraction in the loan spreads, but we expect that should start expanding again because we will want to keep expanding the loan spreads as we go along from here on. The only point I made is that right now we are going through a little bit of an aberration in the external environment because of some of the liquidity tightness and the way rates have actually moved up in a very short period of time.
Okay. And lastly, just on this 14% quarter-on-quarter current account, what will explain that?
No, I think current account is one part. There, I think we are continuously working, and we would be seeing either the similar or a better growth on the current account balances. Because if you have seen, even our average current account balances are doing very well, and the kind of the customers in terms of the solutions which we provide, I think we would continue to get better current account balances.
So this is not a period. I mean, there's no one-off in this current account.
No one-off. I think this is a very, very sustained. I think the momentum for us, which would continue to improve.
In fact, if you also look at, let's say, the average balances, Saurabh, and we're talking about actually daily average balances, even those have grown by 38% on a year-on-year basis.
Yeah. So, yeah. Great. Thank you. Thank you, guys. I'm happy to have it.
Thank you.
Thank you. Next question is from the line of Hardik Shah from Goldman Sachs. Please go ahead.
Yeah, hi. Thanks. This is Rahul here, and good evening, everyone. A couple of questions. First is it possible to know the retail deposit mix within the term deposits that we have, in case I've missed out?
So within the term deposits, the less than 2 crores book that we have is about 31%, Rahul.
Understood. Got it. Understood. Thanks. And the borrowing costs that we have on an incremental basis, due to the ratings upgrade, have you seen any potential benefit playing out? And even on the stock of, let's say, borrowings, et cetera, or, the wholesale deposits, if the benefit already hasn't played out, then by when do you expect that benefit to start playing out?
So Rahul, see, I mean, in terms of the borrowing, I think we have to look at the progress and the improvements that we've seen in the ratings, and also a very significant, I would say, liquidity tightening and increase in interest rates. I think the pace at which I would say the external environment has actually evolved has been very fast, right? So I mean, there is a very difficult one-on-one correlation to establish in terms of how can I demonstrate an increase in the spreads. What we can definitely see is that our deposit growth ability to access deposits continues to improve. What we are trying to focus on is relative deposit rates relative to competition. I think we are quite confident about that. Yes, liquidity has tightened, but I think we will continue to work on that. Our access, let's say, to long-term lines, let's say for refinancing, for example, I think continues to be quite strong. In fact, let's say in September quarter, we've looked at refinancing borrowings in the range of about 3,500 crores, and we are talking about 3-4 year money as well, where we've actually raised. So, what I can definitely say is there is no constraint that we've seen. We continue to see improving pricing relative to what we were about 6 to 12 months back. But I think you also have to juxtapose the recent, I would say, increase in rates and the liquidity tightening position.
Got it. So then,
but normally the advantage of the rating upgrade in the pricing always happens when there is a normal situation on the liquidity, or when the situation would move towards the normal liquidity. I think in the current times, it is more about the access to liquidity rather than the pricing.
Understood. That's helpful, sir and Niranjan. Just two small questions. One is, the tax rate currently stays at about 25 odd %. Do we expect to get benefit from the deferred tax asset at some stage, which will potentially bring down the tax rates?
So Rahul, the way the accounting will happen is that we will continue to report tax at 25%. The benefit that you will see is that as and when we have profits, those will start accreting directly into my net worth rather than getting adjusted at CET1, because the DTA will start getting released. I think you're not going to see in our reported earnings. Reported earnings will continue to have a provision for tax at 25%, but the accretion to our CET1 will actually be more than what we see at a PAT level.
That's okay. Understood. So has it already started?
In a simplistic way, if we are looking at, let's say, a PAT of 100, what I'm accreting effectively to, let's say, to the CET1 is going to be 110%. It's actually going to be 110, not 100.
Understood.
And that extent is...
That's already happening as we speak.
That's already happening as we speak. That's correct.
Understood. The last question is just a view on the savings rate, because I think a large public sector bank, or actually both SBI and Canara Bank, have raised the rates on savings deposit in certain buckets of deposits, ticket sizes. Any thoughts that you all have about what your bank's stance would be?
No, I think this is an evolving situation. Okay, where like the large public sector banks have started increasing the rates. I think in very recently. Okay. It also shows very tight liquidity position into the market. But I think the function in terms of getting the liquidity is not always in terms of pricing. It is always also in terms of the customer connect and the customer service. Okay. But yes, there are absolutely headwinds in terms of getting the liquidity at the right price. Okay. But at the same time, we also need to appreciate that this is something which is very, very critical for the banking industry, for any bank. Okay. Everybody would try. And we are also moving in the right direction. But I think the whole issue would be in terms of the right mix between the current saving and the term deposit. So if you are able to provide the solutions to your customer, then I think getting a good mix from the current account side, that solution is there.
Understood. Got it. Sir, thank you so much, and wish you and your team a very happy Diwali. Thank you so much.
Thank you so much, and wish you all the same.
Thank you. Next question is from the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi, sir. Good evening. Sir, first on your JC Flower deal.
Jay, sorry to interrupt you. Your audio is not very clear. May I request you to speak a little louder, please?
Yeah, is this any better?
No, it's got a little worse.
Hello? Yeah, is this any better?
Yes, much better. Thank you.
So, sir, regarding the JC Flower deal, wherein you also intend to acquire up to 20% equity stake there, what could be the quantum and what could be the implication on your CET1?
I think that 20% would translate into something around just 300 to 350 crores. Because it also depends on actual when the portfolio would be transferred. It would be net of the recoveries made subsequent to 31st March. So I think the capital which would be required from our side when we'll go for 19.99% would be somewhere between 300 to 350 crores, which is not having any significant or minimal impact on our capital.
That's right. 13-14 basis points.
Yes. Yeah.
Right. No. So that is insignificant. The second question is on your guidance tracker. So you have said that PPOP to assets is mostly on track. That number, if we calculate, is around 90 to 95 basis point or less than 100 basis point of asset. So just wanted to check, what is the outlook on that matrix, PPOP to assets?
So PPOP to assets, our expectation is that we should see at least about a 10 to 15 basis points more expansion as we kind of go along. If I actually look at, let's say, the DuPont for the bank, excluding, let's say, the NPA position or portfolio, the broader structure is we have about a 1.2% operating profits on the ex-NPA book, and actually a provision cost is about, let's say, 15 basis points on those assets. They actually are running about 85 basis points of, let's say, ROA actually on the good bank. Of course, there is the drag that's coming from let's say, the legacy book. So the point is on the NIM expansion, when we look at fees to assets, operating costs, like we have been guiding, I think we believe we have capped out at 2.6% assets. I think about a 1 to 1.1% at the full bank level is where we will basically be for this particular year, financial year.
Yeah. No, so even for your medium-term target, when you intend to reach ROA of 1 to 1.5%, how should the PPOP look like? So that is the question, and I think so. Yeah. So that is the thing.
So Jay, if you look at a long-term target, the net interest margins of 2.6, clearly, our expectation is that we should move into a NIM trajectory of 3.25 to 3.5% from a medium-term standpoint. When we look at fees to assets, which is ballpark at about 1%, our expectation is that we should move to about a 1.2 to 1.3% fees to assets. That kind of takes us to revenues to assets of about anywhere between 4.5 to 4.75%. If I take cost to assets, let's say, because that's some efficiency will also start building in after having capped out at 2.6%. So cost to assets at 2.5 essentially takes our PPOP to assets at about 2%. So I think that's really what our expectation is in terms of building out. But this is not this is not a very near-term thought process. I think it's a very execution-focused quarter-on-quarter where we like to keep improving on our margins, keep improving on our cross-sell fees, and continue to keep improving our cost of acquisition and running the business to ensure that we are efficient on cost as well. So I think that's the combination that will play out on our PPOP to assets.
Right. Sure. And just lastly, if you can disclose the sector of the exposure that you said that which has slipped out of restructuring book, and this is a bit chunky, that would be it, sir.
So there was only one account on the real estate side. Okay. And it just slipped into NPA. Yes.
Sure, sir. Yeah. Okay. Thank you so much, sir, and all the best.
Okay.
Thank you. The next question is from the line of Srinivas, individual investor. Please go ahead.
Yeah. My question is, in the last 1 year, Yes Bank has gone on a branch expansion spree. So now the rising interest rate environment, is it, giving you the envisaged level of growth in business, or those branches are not able to generate the required operations or profits? Is that the reason for increase in the OpEx?
So, as regards our expansion plan, we have opened close to 25 branches in this year. The opening of branch, the selection of the location and the placing of the branch is strategically done to see that, it is in the vicinity of a high deposit center as well as a credit center. From that extent, all of these branches are actually doing reasonably well and as per the plan. And we are actually able to see a good traction on the overall deposit and the customer base getting created in and around these branches.
I think this question was also on respect to OpEx.
Okay, but on the advances side, are these branches contributing?
So as I said, most of these branches, we are not only going with the deposit center, we are also evaluating a good credit market in and around that market, and hence on day one, these branches are operational on both deposit as well as on the asset generation, from as far SME as well as on the retail. And the size of these branches typically are actually not very large branches, but in high potential areas which can give us enough and more customers.
Okay. So my second question is actually, there is significant increase in the provisioning in this quarter. So, is it because of slippages? If slippages have reduced, then is it entirely because of the aging-related provisioning? What is the mix between aging-related provisioning and slippage-related provisioning in this quarter?
So, just two accounts have contributed to about 740 crores of aging-related provisioning. Of course, there are more, but I'm just saying it at the headline level, 740. If you look at our net provisioning that we've had, that's about 570 crores. So clearly, more than 100% is actually coming in from the aging related. I think the rest is all getting utilized.
But if you see on the gross basis, the slippage provisioning is only 10% of the total provisioning. On the gross basis.
Okay, and as a sequel to this query, next quarter, because entire NPAs will be moving out from Yes Bank, can we assume that the provisioning will be significantly lower in Q3?
I would not be saying this because the regulations applicable to NPAs and the regulation applicable to security receipt, they remain the same. So it is only like the 15% cash would come, and for remaining 85% of the net NPA, which would be converted into the security receipt, the provision implications would continue to be the same.
Okay.
Thank you very much. I now hand the conference over to Mr. Prashant Kumar for closing comments.
Thank you once again, everyone, and wish you and your families a very happy Deepavali.
Thank you very much. On behalf of Yes Bank Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.